Great. Thank you.
Okay. You have a copy of your presentation, or do you need a copy?
I'm sorry?
You have a copy?
I have a copy, yeah. Thank you.
Okay. Good morning, everyone, including those who have joined online. We are absolutely delighted to have with us today Professor William B. English. He is Eugene F. William Jr. Professor of the Practice Yale School of Management. Professor Bill English joined the faculty at Yale University in 2017 after 25 years at the Board of Governors of the Federal Reserve System. Bill teaches and conducts research on monetary policy and central banking issues with students in both the School of Management and Economics Department. His work has been published in the American Economic Review, the Journal of Monetary Economics, the Economic Journal, and the IMF Economic Review. Of course, he has published his articles in many other journals. Before coming to Yale, Bill was the senior special advisor to the Board of Monetary Policy, and prior to that he held a range of positions at the Board of Governors, including from 2010 to 2015, Director of the Division of Monetary Affairs and Secretary to the Federal Open Market Committee, FOMC. While at the Federal Reserve, Bill visited White House Council of Economic Advisors and the Bank for International Settlements. Prior to joining the Federal Reserve, Bill taught at the University of Pennsylvania and the University of Chicago. He received a PhD in economics from the Massachusetts Institute of Technology in 1986 and a BA in economics and mathematics from Yale University in 1982. He has recently published a book titled Monetary Policy Responses to the Post-Pandemic Inflation. The book focuses on how swift and aggressive actions by most central banks after the COVID pandemic helped contain inflationary pressures with much less pain for the real economy than expected. He draws some lessons from the experience of the past few years, emphasizing that central banks cannot ignore inflation risks, especially in an environment where inflationary pressures can rapidly fluctuate due to unforeseeable global shocks. By the way, today Bank of Japan has raised the policy rate.
They did?
Yeah, okay. After many years. After 17 years, and they have also done really the negative interest rate policy and also the yield control management. But the US Fed is in news again. As you know, the US Fed has raised the policy rate by more than 500 basis points. Despite this massive tightening, many observers feel that the US economy will be able to make a soft landing. That is, it will not face the recession. As inflation in the US has declined sharply from the peak of 9.1% in June 2022 to about 3.2% now, financial markets also believe that the US would start cutting interest rates soon. There is no better person than Professor Bill English to speak to us on US monetary policy. The topic of his talk is US monetary policy at an uncertain moment. Professor, this is a hybrid event. Some people have joined online, including Dr. Mohan. He spoke to me in the morning. He's also attending this event virtually. So we have 90-minute session. Mm-hmm. So you will have about 25-30 minutes to make your presentation. After that, we'll have some conversation. Then we'll open the floor for discussion. Over to you, Professor. Yeah.
Okay. Thanks so much, John. And thanks for all of you for coming, and for those who are online. What I'd like to do with my half hour or so is cover four things. First, how did we get here? How did we get to the current situation? That will draw somewhat on the book that Janak mentioned, which looked across many economies, but I'll focus on the US case. That seems most timely. Among other things, as you probably know, the Federal Open Market Committee is meeting today and tomorrow, so we'll get an update from them tomorrow. Then I want to talk about the economic situation and the outlook, talk about some implications for monetary policy, and end with a few complications. The situation is one that is, I think, more complicated than it may seem, and it seems complicated already, so I'll end with some thoughts on that. So how did we get here? The pandemic hit in the spring of 2020, and policymakers around the world, but but my emphasis will be on the United States. We're very worried that the outcome could be something like what happened after the financial crisis. That is, the economy could be weak for years. After the financial crisis, the economy didn't really get back to potential for something like 7 years. The unemployment rate was high, growth was relatively weak, and they were afraid they were in for another very long, weak, halting recovery. They were worried about what that would mean for the labor market, that some workers would just become detached from the labor market, their skills would deteriorate, and they'd never get back into the labor market. There'd be a permanent effect on potential output. And they were worried about a range of structural changes that the pandemic was raising. The issues around deglobalization and supply chains, issues around cities and work from home, and what does that mean for office space, in particular in large cities. And issues about kind of goods versus services, and would there ever be a shift back to the service economy that we had before the pandemic. So the response was an extremely powerful fiscal and monetary response. So on the monetary side, on the left, I'm showing the Fed's securities holdings. They just skyrocketed. I remember when I was FOMC secretary, debates around very small seeming changes in the Fed securities holdings. Boy, they really went out and bought a lot of securities in 2020 in particular. So very easy monetary policy, very aggressive fiscal policy. The right-hand side shows the government surplus in the US. You can see the surplus plummeted, huge deficits for a couple of years as the government spent a lot of money to try to get the economy going again. And there was a lot of very firm guidance issued. Not only was policy easy, it was going to stay easy for a long time. So they said they're not going to raise rates until labor market conditions have basically attained maximum employment, the mandate that the Fed has. Inflation has reached 2, their assessment of their inflation target, and is expected to be above 2 for a while. So a commitment, or at least a soft commitment, not to raise rates for a long time. And asset purchases, similarly, a soft commitment to continue purchases for quite a long time at a very rapid pace. They did put in an out, so there was some words that the committee would be prepared to respond if risks emerged, but of course they never actually took that out. So a very aggressive monetary policy response out of concern that things would move very slowly. But what happened was inflation picked up very sharply in the spring of 2021. And basically continued to surprise on the high side for quite a while, through 2021, through 2022, even into 2023. The charts here show forecasts of inflation and actual inflation from the IMF's World Economic Outlook, various vintages. And what you see is for a year and a half or more, the forecasts were too low. Inflation just continually came in higher than was expected. Oops. Sorry. Here we go. That inflation reflected a range of things. There wasn't a simple story behind the inflation. There was an unexpectedly strong rebound in activity. We hadn't ever seen a pandemic of this sort. And so part of what happened, I think, was just that economies rebound faster than you might have thought after a pandemic. You can put the pieces back together again more quickly. The second was supply chain disruptions. There were just breakdowns, particularly of international supply chains. In the US, the prototypical example is autos. So US auto companies had huge demand for autos. People got checks from the government. They wanted to go buy cars because they didn't want to ride mass transportation and be exposed to the virus. So they went out to buy cars. The car manufacturers could make cars. They couldn't make chips. And chips are required in the cars, and so there was a big constraint on the supply of cars. As a result, auto prices went up about 25% over the course of the pandemic. So those supply chain disruptions contributed a lot to the inflation. There were commodity price shocks, in particular after Russia's invasion of Ukraine. There were big energy price shocks. There were big food price shocks. And there were big labor market dislocations. There was, as a result of the pandemic, a need to reallocate labor. You needed to move labor from service sector jobs to goods producing jobs because there'd been a shift in demand from services to goods. People didn't want to go to the movie theater, they wanted to buy a TV. People didn't want to go to the gym, they wanted to buy a Peloton bicycle. So there was a shift across sectors. And there also is a geographical shift. In big cities, people weren't going to work because of work from home. They were staying home in the suburbs, but that meant a lot of the services provided to office workers, which used to be provided near where they worked in cities, now had to be provided out in the suburbs. So there was a geographical shift in employment. And those labor market dislocations took a while to get sorted out. And in the meanwhile, there were constraints on supply. And again, that contributed to the high inflation. So very high inflation. One important point to recognize, and as emphasized in the book that Janak mentioned, is this was a global shock. There was high inflation everywhere. This chart, the details aren't important, but the idea is kind of how correlated is inflation across countries. There's always some correlation, there are always some global shocks. So the light blue bars are pre-pandemic, kind of what is the correlation across countries for inflation. The dark blue bars are after the pandemic. And you can see there's just much more correlation in the inflation. Inflation went up almost everywhere. And so we ended up with a global inflation shock. So the Fed initially said, well, this inflation, there are these shocks for sure. Inflation has gone up, absolutely, but it will come back down. The shocks are transitory, inflation will unwind. We needn't move really quickly to combat this inflation. So they did what they referred to as looking through the inflation. The inflation shocks will take inflation up, they'll pass, inflation will come back down. Look at the far side. What will inflation be coming out the far side? And they thought inflation would come back down relatively quickly. So long as inflation expectations remained well anchored, the high inflation didn't get kind of built into wage and price setting. They thought they would not have to respond with monetary policy. That desire to look through the inflation was also reinforced by that forward guidance I mentioned a minute ago. The guidance they had provided was they were going to keep rates low for a long time. They were going to keep an accommodative policy for a long time, and so they wanted to do that. The stories were pretty similar in other advanced economies. In Europe, at the Bank of England, most notably maybe at the Reserve Bank of Australia, where they made very strong commitments and then really did have to back out of them because they couldn't sustain that. But ultimately, across all of these economies, the inflation was high enough for long enough, just the sequence of shocks was big enough that they had to respond. They couldn't just let the inflation remain high, not take action. They would have lost control over inflation expectations. The inflation would have gotten built into wage and price setting. And then they have a big problem. Then you have to try to respond. In a belated way, we saw in the 1970s in the US. That's very damaging. Very high cost. And so over time, countries turned to raise rates. The chart here shows the timing of the increases in rates and what was inflation at the time of the increase in rates. And what you see on average across the countries is the emerging market economies raised rates earlier. They had less confidence in their credibility. They kind of had to respond. Also, in some cases, exchange rates depreciated a lot. The advanced economies generally somewhat later, and they raised rates when inflation was higher. India is an interesting case. It's over to the right, raised rates somewhat late. I think the answer to that somewhat surprising result is the effects of the pandemic were worse here. The real side effects were more damaging, and so the RBI waited somewhat longer before they responded to the high inflation. I think there were also risk management arguments. So in the initial period after the pandemic, as inflation was going up, the initial thought from the Fed was we really don't want to end up as we did, say, in 2010, 2011, 2012, with inflation low, output weak. That was a really damaging outcome for the economy. And so they wanted to respond more aggressively. And as I showed earlier, they did respond aggressively. But then as the inflation built in, got higher, got even higher, they saw the risks pointing the other way. The risk was you lose track of inflation expectations and you end up with a high inflation economy, and then you've really got to respond, and that could be very costly. So I have a quote here from Chair Powell in May 2022. We can't allow a wage price spiral to happen, and we can't allow inflation expectations to become unanchored. It's just something we can't allow to happen. So they responded with risk management, and they raised rates even faster and even further than perhaps they would have otherwise. So they raised rates more than 5 percentage points in about a year. The fastest rate hike cycle since the Paul Volcker era in the early 1980s, which I remember, but many of you probably won't. By last summer, rates were high. The Fed said they were sufficiently restrictive. They stopped raising rates, but they've left them high. So this is the same pattern that we've seen in a number of advanced economies. Rates went up quickly, and then they're just keeping them high. What Hugh Pill at the Bank of England has called the Table Mountain approach. You raise rates, then the issue is how long do you wait before you start cutting rates? And that's the big issue before the committee right now. So they thought that the economy would grow slowly. They thought the unemployment rate would move up to about 4.5%. These are forecasts from last summer from the FOMC. And inflation would gradually return to target over 2 or 3 years. But things haven't played out in exactly the way that they expected. So let me turn to the economic situation, current economic situation, and the outlook. So the incoming data since last summer have been surprising. The left-hand panel here is GDP growth. The Fed expected GDP growth to run around 1%. Potential growth, kind of trend growth in the US is around 2%. So they thought it would be a bit below potential. It's been a bit above potential. It's run about 3 instead of 2. And then on the left-hand side, on the right-hand side, the unemployment rate has stayed below 4. They expected it to rise to around 4.5. And payroll growth, just the additions to employment each month, have run around 200,000 or something like that per month. Neutral, just keeping up with demography, growth in the population is about 100,000. So the economy's been pretty strong over the past year or so. The labor market dislocations have improved. The left-hand side here shows quits and job openings, which reached extraordinarily high levels historically. In 2022, they've come back down. And labor force participation is on the right-hand side. That's recovered more or less to trend, as you would have expected, because it does trend down a little bit because of aging of the population in the US. Inflation has come down. Despite the stronger growth, the lack of slack, inflation has come down, but not all the way to target, not back to 2. It's kind of around 3 or something like that. And the right-hand chart here shows wage inflation in the US. There are a couple of measures. We can talk later if there's interest about the differences, but the basic punchline is the same. Wage inflation is running around a percentage point faster than it was pre-pandemic. So wage inflation hasn't come down yet to levels consistent with the Fed's 2% inflation target, and inflation hasn't come down yet to levels consistent with the inflation target. The outlook for real activity, I've got this is simple measures of purchasing managers' views of the situation and the outlook. The manufacturing sector is a little bit below 50. That means shrinking just a little bit. The service sector is growing above 50. They're kind of because in the US the service sector is much bigger than the manufacturing sector. They're consistent with growth in the economy. So the economy continues to grow a bit faster than potential, as near as one can make out. Nonetheless, inflation has come down as the inflation shocks have passed. And the question for the Fed is more or less what's next? Will inflation continue to come down? Will the economy slow further? And it's hard to say. These are expectations for inflation. On the left, market-based expectations. They've come up a little bit from before the pandemic, but that actually is probably good in the sense that they were too low before the pandemic. After a decade of low inflation, after the financial crisis, expectations had been pulled down some. So I think the Fed's okay with longer run inflation expectations having moved up. The right-hand panel is a survey of households. That's very noisy. It's come down. It's probably still, on average, in recent months, a bit high. That's consistent with the thought that there's a little too much inflation, a little too much wage inflation in the economy still. So what are the implications of all of this for monetary policy? I think they're not clear. If the economy stays on track, that is, output kind of stays near potential, and inflation continues to move down towards target, say over the next year, then pretty soon it will be time to start easing monetary policy. Why is that? Well, as inflation comes down, real interest rates are higher, nominal interest rates adjusted for inflation. And so in some sense there's an automatic, perhaps unintentional, tightening of monetary policy as inflation falls. And so I think the Fed will want to avoid that, in all likelihood. And so at some stage they'll say, everything's on track, everything's going the way we want, and it's time, just as almost as a technical matter, to reduce nominal interest rates to avoid an undesirable tightening of financial conditions and an economy that slows too much. There are risk management arguments that policymakers are discussing a lot. On the one hand, you could do too much. That is, you could leave rates high for too long. You could slow the economy too much. And that way you could end up in a recession that you don't need to bring inflation back to target. It may be it's going to come back to target gradually over time. And we don't actually need to have a recession to get there. And this is particularly complicated because there are lags in how monetary policy works. There are a range of estimates, but monetary policy probably has effects on output that take a year or two to be fully felt, effects on inflation that take a bit longer. And so monetary policy was tightened very aggressively in 2022. We're still feeling some of that now. The economy will be slowing in 2024 because of that series of very significant rate hikes in 2022. So there's still a little bit of tightening, at least in the pipeline, and they'll want to worry about that. The other is, I refer here to the Somm rule. My former colleague Claudia Somm at the board came up with a historical regularity. If the unemployment rate smoothed a bit, goes up by 0.5 percentage point over 6 months or so, the economy basically always falls into recession. And so if the economy slows too much, I think what happens is households and businesses say, uh-oh, we could end up in a recession. Better hold back, right? Bad time to buy a car, bad time to invest in new equipment. But if everybody holds back, then the economy falls into recession. But there is that sort of nonlinearity, and you have to worry something about that, I think. So there's a risk you end up slowing the economy more than you want to. On the other hand, there's another risk that you don't do enough. You don't slow the economy enough, inflation stays high. You end up, say later this year, with the economy kind of at potential, the unemployment rate at its longer run normal level around 4%, and inflation around 3 instead of around 2. And that's a pretty bad outcome as well. Then you have to decide, do you slow the economy more? Do you tighten monetary policy? And that would be a very hard decision. So I think at the moment, probably these risks are roughly balanced. For a while, they were much more worried about the high inflation outcome, doing too little. But I think now probably these two things are roughly balanced. Let me end with a few complications that the monetary policymakers face. One is what's going on with inflation. So inflation has come down quite a lot. But if you slice it into pieces, so here I've taken a chart from the most recent monetary policy report that the Fed published a couple weeks ago. One piece is basically goods. That's the dark line that went up a lot and then has come back down a lot. As I said, goods prices are now actually falling on average. And so there's been a big decline in goods price inflation. Part of that, though, may be temporary, right? The price of cars went up a lot during the pandemic period because it was really hard to make cars without chips. Now prices of cars are actually falling. They're down over the last year or so. Not a lot, but some. But that decline is supply is catching up with demand. Supply is now roughly probably caught up to demand. It isn't clear you're going to continue to see declines in auto prices. Auto prices probably will stabilize at some stage. So that negative effect on inflation coming from goods prices may not last. Inflation on goods may pick up a little bit. Inflation in services, which is the middle line, has come down from around 5 to around 3, but it's still pretty high, actually. That's consistent with the relatively elevated wage inflation I showed you earlier. Services, a lot of services are just labor, right? It's just workers. And if workers are getting raises that are too high to be consistent with the 2% inflation target, then that will show up in the services piece. And I think that's what you're seeing there. The kind of wild card in this is housing. Housing is measured in a somewhat strange way in the US. I'm not going to get into that unless somebody asks me to. But housing prices, the key thing is that housing inflation lags what's going on with new rents, and it's measured using rents. So we know that rent inflation has come down a lot. It hasn't shown through yet to the housing piece of consumer prices. It's come down some, but it's still pretty high. That's the top line on the right-hand edge of this chart. And there's a real uncertainty about what's going to happen over the next 6 months or the next year. A lot of people think that will come down a lot further, given what we know has happened to new rents. But it hasn't, the pass-through from new rents to the housing piece of consumer prices hasn't been as clear as people had thought. And so there's a real question of what will happen to inflation. So there's uncertainty about inflation. There's also uncertainty about real activity. Is the economy really as strong as it seems? There are a number of indicators that suggest maybe not. The left-hand graph shows real GDP. That's the blue line. I pointed that out earlier. I said that's grown very strongly over the last year or so. The red line is gross domestic income. National income accounting says these two things should be the same. The difference is a statistical discrepancy. Ordinarily, they kind of move together. They've not moved together over the last year or so. Gross domestic income has grown much more slowly than gross domestic product. On average, what do you want to do? You kind of want to average these things, right? That may suggest growth is actually slower than the 3% GDP growth that we've seen and that people focus on. The GDI numbers are a little bit of a signal that things may not be as strong as you think. The right-hand side is hours, aggregate hours worked. That's basically trend-like. So maybe consistent with growth around trend, around 2%. Again, it doesn't suggest growth around 3%, which is what the GDP numbers show. The US labor market data is drawn from two things. There's a survey of businesses and a survey of households. The survey of businesses is bigger. It tends to have smaller errors. It's a great survey. The survey of households is noisier. It's a smaller survey. That survey of households shows total number of workers growing much more slowly than the survey of businesses. That could just be statistical error, sampling error. But it also, again, might be a signal that the economy isn't as strong as the headline payroll numbers that you see in the employment report. So I think there is some reason to believe the economy is a little weaker than you might have thought. And that's a real issue if you're a policymaker. And you don't want to do too much. You don't want to drive the economy into recession. So it seems right to wait, see more data before acting. But you don't want to wait too long. Right? If you keep rates high for a long time, you run the risk that the economy really will slow. So I have two quotes for you. One is from the last FOMC statement. They said the committee doesn't expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably towards 2%. So that's saying it's going to take a while, right? We have to get more confidence. However, in his monetary policy testimony a couple of weeks ago, when asked about this, what Chair Powell said was, when we get that confidence, and we're not far from it, it will be appropriate to dial back, et cetera. And so that, and we are not far from it, that wasn't said lightly. And so he really was suggesting it could happen reasonably soon. They've said, in effect, not this month, probably not May, but June seems in play, and we'll just have to see how did the data turn out and where do we end up. One final complication, just for those who are aficionados, is what is the Fed going to do with its balance sheet? So it's shrinking its balance sheet now, allowing securities to mature and run off the balance sheet. It's actually shrunk a fair amount. That's the top line on the left. So, the Fed is going to normalize the size of its balance sheet. That too is tightening monetary policy. As the Fed's balance sheet shrinks, that puts some upward pressure on longer term interest rates. Exactly how much is subject to considerable debate. But this is a form of tightening too, and they have to decide when are they going to stop shrinking the balance sheet or slow the shrinking of the balance sheet. They said in advance of the meeting that's going on today and tomorrow, this is a main topic for discussion. I expect they had a briefing at the meeting talking about their balance sheet and different possible strategies for shrinking the balance sheet. It'll be very interesting to see what they say after the meeting. That's all I have. Thanks so much.
Yeah, thank you very much, Professor, for this very lucid presentation.
Yeah, you're welcome.
So let me go back to the observation you made about that Fed was believing that inflation was transitory.
Yes.
But when the Fed was insisting that inflation was transitory, many observers, including Muhammad Al-Arian, they were regularly pointing out that inflation was not transitory. So, but the issue is that what really went wrong in reading the inflation number by the US Fed? Was it that it underestimated the true nature of the supply shock, or was it lulled into complacency? Because inflation after the global financial crisis, most of the time, it was below the target of 2%.
Yeah.
And Ben Bernanke, of course, has indicated that the Fed was, didn't want to shock the market. He was referring to the September 2013 taper tantrum, when he talked about they will be, gradually, tightening monetary policy, and the financial markets were in turmoil. So what really went wrong? Like, what was the main reason for which the US Fed that the inflation was transitory when it was not, and then of course later on it admitted, and then of course they had to take very aggressive monetary policy action.
Yep. So let me challenge a little bit your question, because there was a fundamental decision policymakers had to make in 2021-23, which was how much of this inflation was supply related and would pass as the supply conditions improved, and how much was simply excess demand and overheating. So there were those, Larry Summers prominently among them, who said basically a lot of this is excessive aggregate demand. Inflation is too high. It's going to stay too high. And he argued when he spoke at Yale in the fall of 22 that the unemployment rate would have to go to 7.5% for 2 years to bring inflation back down to target. That was wrong, right? Inflation has come down a lot since then without the unemployment rate rising very much. It's still below 4. So I think the policymakers at the Fed had to make a fundamental judgment about how much of this is supply related and how much of this is just excess demand, overheating, something that they really had to address with very tight monetary policy. Their judgment was, even after they stopped using the word transitory, they still thought that a lot of this was supply related and would pass. And I think their judgment on that was pretty good. There's a very nice chapter in the book that you mentioned by Ben Bernanke and Olivier Blanchard, where they decompose inflation into pieces and across 10 countries, 10 advanced economies. And the upshot of that analysis is the inflation was high, largely because of supply problems, supply disruptions, oil prices, food prices, and so on. That has come out. There is a remaining piece, right? There's a slice in the US, I think they estimated at roughly 1 percentage point, that has to do with overheating, tight labor markets, and may require some slack to bring it down. This I think is the argument that some have made, that the last mile is the hardest. Right? Inflation has come down to around 3, and the question is, will it continue to move down at low cost to something like 2, or do they actually need to have some slack? And that's the judgment the Fed is trying to make now. But I think the initial thought that this was supply related, likely to be transitory, wasn't crazy, but the shocks just kept on coming. And so the inflation just ended up higher for longer. And at that point, your credibility as a central bank is called into question. You have to respond.
Yeah, so my next question is about this only, like inflation touched 9.2% in June 2022, which was 40-year high after great moderation in 80s.
Yep.
This was the only period when inflation reached this high. So did it dent the credibility of the US Fed, and that was the reason that why they did take very aggressive actions?
So I think they certainly were worried that it would call into question their credibility. I think if you look at the data on inflation expectations, the longer term expectations stayed pretty well anchored near target. I think people still believed the Fed would bring inflation back to 2. But the kind of short and medium term expectations moved up a lot. And I think the reason for the very aggressive action taken in 2022 is they were worried, right? They were afraid that expectations would come more unanchored, go up much higher, and make getting inflation down much harder.
Okay. Now let me come to, now this was of course question of credibility of the US Fed, but now most observers feel that the US is going to make a soft landing. If we see the track record of the US, most of the time when it did so much aggressive tightening, the US had to face recession. But this time it looks that the US could avoid recession and there would be soft landing. So my question is, how far this time is different from the earlier periods when the US had to face recession? So could you please indicate some of the major factors which are different this time than on the earlier occasions?
Yeah. So go back to the 1970s. There were supply shocks. Inflation went up. But the Fed's response was incomplete, I guess. Right? They raised rates enough to cause recessions, but not to return inflation to some really low level. Inflation went up, then it came down, but it was higher than it had been before, and then it went up and it came down. So that kind of stop-start policy really did cost them in terms of credibility, and I think that this time they moved with sufficient speed that their credibility was not seriously undermined, and that's helped a lot. As the inflation shocks passed, inflation has come down. But we'll see whether they need to have an economy that's weak. The most recent projections, we'll get a new set tomorrow, but the December projections had the unemployment rate basically coming up to its neutral level, around 4, a little bit above 4. And they thought that if they could normalize conditions in labor markets, that would be enough. The rest would gradually taper off over a couple of years. I think that's a judgment, and that's a question. And over the next few quarters, we'll see, does inflation kind of hang up, as I said, is a concern, in which case they may need to leave rates higher for longer. They may need an unemployment rate that goes up to 4.5% or something like that to bring inflation down. But the hope is that with inflation expectations well anchored, which they seem to be, inflation will simply wane over time, and we'll get inflation down to target without at least a significant recession, maybe a period of slower growth, and so a somewhat higher unemployment rate. Maybe it goes above 4 for a while, but not very far. And that, given the scope of the shocks that hit and how bad conditions were, that seems like a great outcome to me.
Yeah. Professor, you showed a very interesting chart on liquidity of the US Fed, like our balance sheet has expanded. The balance sheet size of the US Fed was like less than 1,000 billion, 1 trillion, less than 1 trillion.
Yeah.
In 2008-09, before the North Atlantic financial crisis, which Dr. Mohan calls it, it's global financial crisis in 2008.
Yeah.
So after the global financial crisis, that expanded rapidly. Balance sheet of the US Fed expanded rapidly. It went up to almost 4 trillion US dollars.
Yep.
And then, of course, it started shrinking its balance sheet. But before it could do much on that, you faced another shock of COVID pandemic, and then balance sheet had to expand again. Now the balance sheet is almost 7 trillion US dollars. So as percentage of GDP, it is now almost 26% of GDP, as against only 7% of GDP at the time of global financial crisis. So my question is it really, I know you have divorced monetary management from liquidity management by paying interest rate on excess reserves. So it's not interfering with your monetary management. I understand that. But is not causing you concern, because it has serious implications for financial markets, and it of course must also be hurting your balance sheet, your profitability, because you must be facing some losses when interest rates had risen sharply. So the security which you are holding in your portfolio, the valuation must have come down. So I have two questions. One, do you have any plans to shrink the balance sheet? It's already shrinking, like from June 2022, you started shrinking, but the pace is very, very slow. So, but do you have any plans that it would shrink to a much normal size than the size which we used to see during the before the global financial crisis? I'm not talking in absolute terms, I'm talking in relation to the size of the economy, GDP.
Yeah.
That's number one. And number two, does the US Fed really fear that if it shrinks the balance sheets rapidly, then that there could be turmoil in financial markets?
Yeah. So in terms of plans, I think we'll know more tomorrow, because they're going to announce at least roughly what they intend. I think an important point is that they did decide back in, I think, early 2019, that they would stick with a balance sheet that was large and use payment of interest on reserves as the way they would set interest rates. So as you say, in 2007, the Fed's balance sheet was small. The supply of reserves was tiny. There was no interest paid on reserves. Yeah. Banks didn't want to hold them. They did other things to obtain liquidity. And so the balance sheet was very small. But they decided, as a result of the financial crisis, they purchased a huge amount of securities. The reserves of the banking system went up a lot. They paid interest on reserves to implement monetary policy. They decided there were attractions to that system, operating with a lot of reserves, that it provided a financial stability benefit, that banks had lots of liquidity, and so in event of a shock, they had big liquidity buffers that they could fall back on, and so on. So they decided at that time they were going to stay with a pretty big balance sheet. Now, I forget how small it got. I think it was 8 or 9% or something of GDP just before the pandemic hit. And that was about as small as it could comfortably have gotten, given that there were strains in some money markets as it got down to that level, roughly. But I think they're hoping to get back to something similar to that, maybe a little bit bigger, because over time, banks and supervisors have gotten used to the idea of abundant reserves, but a lot smaller than now, I think. but they're worried that they'll shrink the size of the balance sheet, they'll shrink reserves of the banking system, and they'll set off some dysfunction in money markets, as happened in September of 2019. So they'd like to avoid that if they can. I think that means they're going to slow down the pace at which they're running off securities, and over time they'll try to see what's going on in money markets, and as strains emerge, maybe they slow down further. But I think they do want to get the balance sheet down to, as a percent of GDP, to something much smaller than it was certainly at its peak, because they don't want it to be the case that there's a ratchet effect. The balance sheet just goes up, because at that point you start to worry that you're going to run out of space. You want to be able to use quantitative easing again in the future, but if you're going to use it in the future, you can't have a balance sheet that continues rising without bound. So they'll want to shrink the balance sheet, and exactly how far they can go, I think they don't really know. But as I say, we'll find out a little more at least tomorrow.
Okay. Now my other two questions are about the impact it has on your earnings.
Yeah. So the income question is a great one. So as a result of the Fed's purchases, it's locking in interest rates on its assets that are pretty low, because it was buying securities when the economy was in bad shape and interest rates were low. And then it had to raise rates very quickly, so it's paying high interest on its liabilities, and it's earning pretty low interest on its assets. So the Fed has had losses for the last year or so, and the cumulative losses, I forget, last time I checked, were 150 billion or something like that, I think. But I'd have to look it up. So there's a question of, how big a problem is this? I wrote a paper a couple of years ago with Don Cohn, my former boss, who's at Brookings, and we argued it's not that big a problem, that the Fed can't default in some sense. It can print money. It's a central bank. So there isn't a capital adequacy problem for the Fed. And the Fed will continue to implement monetary policy appropriately. So there isn't an economic problem in that sense, that monetary policy somehow goes haywire. In terms of accounting, the way the Fed's accounting works is when it has a loss, it writes down that when it returns to profitability, it will retain earnings to offset the loss before it starts paying its earnings to the Treasury again. Normally it just pays its earnings to the Treasury. So it will be not paying earnings to the Treasury for a while in order to offset the loss that it had. But that's a system that seems like it works, and the Fed will be able to do that. We also argued in that piece that it's very important to not view the Fed's losses as kind of the full assessment of the costs of QE, for example. QE has a bunch of benefits, a bunch of possible costs. It puts more people to work faster. It pushes down longer-term interest rates, allows the Treasury to finance itself at lower rates. So it has a range of benefits, a range of potential costs. Back in the period around 2010, 11, 12, we did a lot of work at the Federal Reserve that's been published. It's on the board website, on kind of cumulatively how do you think about the benefits or costs, and our bottom line was think about something like the debt to GDP ratio. That may end up higher or lower. If the effects of the QE on the economy are pretty big, even if the central bank has a loss, the society as a whole may have a gain, and you need to think about that. You also need to think about uncertainty. If you're in a situation where you're making a judgment that you want to provide additional accommodation, and you understand that providing that additional accommodation means there's some probability that you'll have a loss if the outcome is that the economy rebounds faster than you thought and inflation rises faster than you thought and you have to raise rates. That may be a risk that you're willing to take in order to get the benefits of the QE. And I still think that's the right way to think about it.
Professor, my next question is concerning the impact of U.S. monetary policy on emerging market economies. If you recall to taper tantrum in September 2013, when Ben Bernanke mentioned about rolling back its
just slowing the pace of purchases.
Yeah. So the emerging market financial markets in emerging market economies, they were in turmoil, as I mentioned earlier.
Yeah.
But this time, US has done massive monetary tightening, more than 500 basis points. But still, it didn't impact. There were capital outflows, but financial markets in general, they stayed calm. So, what do you feel was different this time? Was it to do with the communication by the US Fed? And my second question is whether the US Fed is conscious of its spillover impact on other emerging market economies of its policy?
Yeah. So, on the taper tantrum, it really surprised me. So I'm not sure I have a great explanation. I remember at the time we talked about the event, and I mean what the Fed chair said at a press conference was that he thought that as the economy continued to strengthen, it would be appropriate to wind down the purchases, but he didn't say it was going to happen really soon. And yet there was a really big reaction, not just in emerging market economies, but in the U.S. economy. Longer-term rates in the U.S. went up by more than 100 basis points in just a few days. So it was a big surprise. I think one way to think about why we didn't see that this time is we did see it before. Right? So people in some sense got used to thinking about monetary policy and communication and balance sheet policy and so on. It was all new then. Right? Nobody had done that sort of communication before, and so it came as a big surprise. I still think I don't understand exactly why it came as a big surprise. What he said was it aligned more or less with what surveys seemed to think market participants thought, but it did. But I think this time the communication was clearer, and market participants were more receptive to that communication. They understood better kind of how the Fed was thinking about things. Things were so new then that it was just hard to get the communication right. On the spillovers issue, this comes up regularly, and I can only give the answer the Fed always gives, which is not entirely satisfactory if you're sitting in Delhi. But the FOMC's policy objectives are objectives for the U.S. economy, and so it doesn't really have authority to take steps that are not aimed at its objectives for the U.S. economy, maximum employment and low and stable inflation. And so the Fed is certainly aware of the implications of U.S. monetary policy for other economies, and it tries to take account of, if you like, the spillbacks from those economies to the U.S. economy. But unless there were a very big risk of spillbacks that would harm the U.S. economy, the FOMC is inclined to just continue to do the policy that it sees as appropriate for the U.S. and trust to foreign economies to use their own policy tools to adjust and take account of how policy is moving in the U.S. I think one striking thing, again, in the pandemic period, is that emerging market economies have done a pretty good job. I mean, one of the points of the book that you mentioned earlier is a lot of emerging market economies managed pretty well. They had their tools, they used them appropriately, they had built
also learned their lessons from that potential.
They learned some lessons, for sure. But I think the sorts of spillovers that people were worried about didn't really materialize this time. Partly, again, that's because communication was easier the second time around. I think partly it was that policy in other economies was better.
Yeah, okay. Professor, my last question is about, before you open the floor for discussion, about the unconventional tools of monetary policy which the US Fed applied. Of course, after you hit the lower bound, effective lower bound, you introduced bond purchases and basically quantitative easing and also gave forward guidance. But many other central banks, including ECB and some other banks in Europe, they introduced negative interest rate policy. And in 2016, Bank of Japan also introduced negative interest rate policy. As I mentioned in my introductory remarks, that now today they have done away with the negative interest rate policy. So my question is whether this issue came up in FOMC meetings about using negative interest rate policy. Was it ever considered?
Yeah, no, it was. So I think in the summer or fall of 2010, so the FOMC had implemented the first really big asset purchase program in, depending on how you measure, late 2008, early 2009. That program had ended. The interest rates were at what we thought of as the lower bound. And the question was, how could you do more? There was a desire to provide more accommodation. And so the committee had to think about how they wanted to do that. Did they want to do more QE? Or did they want to take rates negative? And so there was staff work done. It's been published. It's on the board website when we looked into that. And I think the analysis basically was two pieces. One piece was how low as a technical matter could you go? So if you try to push rates too negative, you're paying negative rates on reserves of banks, for example. The banks can hold cash,
physical cash,
right,
yeah.
In a vault. And so the question was kind of how far negative could you go? I forget now what we concluded. I think we looked at insurance costs and shipping costs and vault costs and so on, and thought something like minus 35 basis points or something was where they could go. So maybe a couple of 25 basis point easings. Then the question was, how disruptive would that be? There's this discussion, I'm sure you're aware of the reversal rate. And if you cut rates negative, you push them too negative, and banks in particular are hesitant to have negative rates on retail deposits in particular, because they think their customers will hate them forever, probably rightly. So they don't want to take deposit rates that negative. Then you're squeezing your banks. You're squeezing their profitability. Their return on their assets goes down. Liability cost stays the same. And so the banking system is less profitable, probably has less capital over time. And so you have to worry, is this actually a productive thing to do? In the US, there was concern also about money market mutual funds, which aren't really set up to have negative interest rates. You buy a share, the price of a share is supposed to be maintained at $1, the money is invested, you get your share of the income. If the income is negative, it isn't quite clear how that works. And so I think we were concerned about that. So in the end, what the committee decided was, given the uncertainties and risks around negative rates, they were inclined to do QE instead. So they did a second round of QE starting in the fall of 2010.
Okay. Thank you very much, Professor. That actually we are in time. Yep. So we now open the floor for questions. Yeah. Yes, please. Yeah.
As an outsider, it seemed to me that the real sector is far more responsive to the monetary policy now than it was in the past. Is there some work on that? Is that the case? And if so, how does one explain the factory construction boom? So just this seems to be counter information which seems to be contradictory.
So there's certainly a lot of work that's been done on what are the lags with which policy works, what are the sizes of the effects of policy on the economy. I guess I'm not aware of work showing a really big increase in the effects of policy on the economy. There's some work that suggests lags are shorter than they used to be. That would make sense, I think. Businesses and households are a bit more aware of financial conditions, respond a little more quickly. Businesses' management of inventories is tighter than it used to be, and so there's probably a responsiveness that's a little faster. But I guess I'm not really aware of a lot of work suggesting differences in the size of the effect. One point I'd make is that there's a lot of uncertainty about the size of the effect. If you look across models, macro models, different models have rather different sizes of the effect of monetary policy. So we know that it works, we know it has some effect, but exactly how big the effects are, there's just uncertainty. There, you know, the data are not that clear on that point. On your second question about spending on factories and such, I think there's a mix of fiscal and monetary policy going on. So fiscal policy has encouraged corporate investment, and monetary policy is discouraging corporate investment. But which of those things wins isn't entirely clear. And tight monetary policy, historically, the research shows the effects of it on investment spending are actually not all that large, and they take some time to accumulate. And so it may be that in the near term, the fiscal policy effects are bigger than the monetary policy effects.
Yes, Rajesh, yeah.
Thank you very much for an excellent exposition of the monetary policy responses post-pandemic, and I'd like to take the real side question forward, because you mentioned at one point that the prices of cars increased because of the chips prices. So that is a lot to do with the real economy, number one. Number two, is there a difference between the monetary policy response in the kind of world that we are now living? It's not just post-pandemic, but this is the trade disrupted world completely. And we all know the basics of efficient allocation of resources, and trade gives much more leeway to being within the inflation limits, you know, because you get, so actually it is to do with the US-China trade war starting pre-pandemic, and then IRA coming into picture, and the other countries also taking some similar domestic industrial policy steps. So that also has to do with the kind of inflation discussion that we are doing. So monetary policy in a trade disciplined world versus monetary policy in a trade disrupted world, any views on that?
So my career has mostly been on the domestic side. So here I'm speaking from a lack of real expertise. But I think what I would expect is that if trade is disrupted, then effects of monetary policy on inflation could be larger because you're going to run up against domestic supply constraints, whereas in the past, maybe with more open trade, you'd instead import and avoid running into a constraint. And there's work done by my co-editor, Kristen Forbes, on global inflation effects, and she finds that kind of measures of global aggregate supply and demand mattered for inflation over the last generation or so more than before. As globalization happened, the supply questions are more about global supply and not as much about domestic supply. It seems like we may be unwinding some of that, right? Domestic supply will matter more, and global supply will matter less as we enter into a period of less globalization. Now, trade hasn't actually gone down yet, and so I'm not sure how big that effect will be. That's still to be seen, but certainly there's a possibility that then the inflation dynamics will change and will depend less on global factors, more on domestic factors.
Yes, Rajat.
Yeah, hi. So what I understand from the discussion is that, experiences play an important role in how any policy relevant decisions are made, especially in the case of monetary policy. So the lack of experience which was there, and the difference really striking from there between the post-pandemic versus the other global issues which erupted earlier, is so can one infer that still our understanding about the complexity of the economy and how monetary policy can be effective in those complications is still not very comprehensive. Is that how we should infer that?
I'm sorry, I'm not quite sure I understood the question.
My question is that, one of the drivers which you also mentioned in your talk was in the post-pandemic era, we were not very sure that how things will react, how things will come back. And this was strikingly different than what we faced earlier as, other global issues. So there was clearly a lack of experience in the way, we would have thought these events to play. So does this mean, and this may happen also in future, there could be some uncertainties which are beyond our imagination and the way they would come back. So is this the lack of complexity the lack of experience coupled with the idea of complications of the economy, and then therefore the response from the monetary policy side, is there something which we still don't understand very clearly?
So I think there are many things we don't understand very clearly, alas. But I think you're right that in the post-pandemic period, the policymakers had to make policy without a lot of information about how does a global pandemic affect a complicated, interdependent global economy. They just didn't know, and so they had to make a bunch of judgments, and they made those judgments on the basis of very incomplete information. In the future, what are the implications for the future? I think that one is that we may face shocks we just haven't seen before, and understanding how they play out and what they call for in terms of policy will be hard. And that's just a challenge that we face. Sometimes you'll get shocks that are kind of familiar. They may not be the same as ones in the past, but they rhyme, and so you can kind of use the past as a way to judge the policy response. But really kind of new kinds of shocks raise a more complicated problem. And that's just the situation that we found ourselves in, I think. No good solution. I think the other lesson from this experience for policymakers, this is kind of what I think you were hinting at maybe before, is that we went through a decade when inflation was too low, and we were frustrated by inflation being too low. Policymakers wanted to get inflation up, and I think when the post-pandemic inflation hit, the initial response was weak in response to the higher inflation, in part because people thought, well, this is going to come back down. Our underlying problem is inflation is weak. The economy is going to be slow. And it took a while to understand that inflation shocks can be big and positive. We just haven't seen something like that in a while, but we got big positive inflation shocks, and ultimately they had to respond to that. So if you're a policymaker, I think you have to look at the possibility of big inflation shocks in either direction, and how do you want to respond to them? And we argue in the book that this calls for a bit more symmetry in terms of the views about inflation risks, and monetary policy in response to inflation risks.
Yeah, Renu?
Thank you for a most stimulating talk. I have more than one question, if that's all right. One is can there be a soft landing? Are there any examples in US monetary history? The second one is to do with the structural shift and the possibilities that the US that the potential output may have raised. I think the Chairman Powell referred to that in a previous meeting a few months back. And in relation to that, some of the charts that you showed a trend shift, and we don't know, of course, that it would last. But certainly the price level is a lot higher. It's significantly above. And the third one is about the credibility of the central bankers. But related to that is the framework of monetary policy that is in use or in operation. if that accommodates tail events like the pandemic, and how does that relate to the persistence and the series of supply shocks, and if that is adequate to cope up with that? Thank you.
All three great questions. So on soft landing, there's one example, at least people point to, which is the 94, 95, 96 period in the US. So the economy was recovering very rapidly. The Federal Reserve tightened monetary policy, not quite as sharply as in the most recent case, but pretty fast in 1994 and into early 1995. Then eased a couple of times and then kind of left rates at a somewhat high level, and the economy performed really well. So that's an example. There's a very nice piece by Alan Blinder, I think it was early last year, going through several business cycles in the US since 1960 or so, and saying, gee, in a few cases, either there was a soft landing, as in 94, 95, 96, or it was close and then was derailed by some other event, just some completely different event, a financial problem or whatever. But he concluded from that exercise that while soft landings aren't easy, on the other hand, they are feasible in the sense that policymakers either produced one or were pretty close to one on a few occasions over the last 50 years or so. So I think it can be done. I was at the Fed early in my career in 94, 95, 96. The thing that struck me at the time was it wasn't clear whether you succeeded or not until you could look back about a year and say, okay, a year ago we were there. But you weren't confident you were there until until you were sure that the lags in monetary policy didn't cause a problem subsequently. So we won't know, I think, if we have a soft landing for a couple of years, probably. On the structural shifts, effects on potential output, that's a really good question, and I'd add to that questions about what is the neutral rate of interest.
Yes.
The neutral rate of interest, we thought pre-pandemic, was probably under 1% as a real rate, 0.5%, something like that. There's some evidence now that it's higher, but how much higher isn't entirely clear. The old story, why was it so low, had to do with demography, slowing population growth, aging of the population, shifting savings behavior, slower productivity growth, and a global savings glut. The global savings glut seems like maybe there's less of that now. Fewer countries, say China comes to mind, may want to hold a lot of reserves in the US in the form of treasury securities, for example. So that effect may be smaller, but we'll find out. The other potential issue there, I think, is U.S. fiscal position is much worse. Debt to GDP is over 100% now, and the deficit kind of in what are basically good times is around 5% of GDP. Those are big deficits. That's big debt, and that should also push rates up. So probably the neutral real interest rate's a bit higher than it was before, but how much higher? It's just very hard to tell. On central bank frameworks and the credibility of frameworks, the Fed announced a new framework in August of 2020 that basically was somewhat asymmetrical, tilted in the direction of providing a bit more accommodation, allowing a bit more inflation. I guess I don't think in the end that had a whole lot to do with the subsequent inflation. We talked about the reasons for the subsequent inflation. But on the other hand, it may have made communicating about policy and communicating about inflation concerns a little harder. And it'll be very interesting to see what they say. They're just beginning now a new framework review. They promised a framework review every 5 years. So they'll do a framework review this year, sometime next year. They'll announce it. The question in my mind is, do they back away some from that asymmetry, having now seen both a period of very low inflation post-financial crisis, and then a period of very high inflation post-pandemic. Maybe you want to be a bit more symmetrical in the framework. That wouldn't surprise me, but on the other hand, frameworks aren't supposed to be knocked around a whole lot by recent events, and so they may be hesitant to make significant changes in the framework. But there's a lot of work to be done by the staff. I'm just as glad I'm not there now.
I suggest we can take up some questions which you have received online.
Oh, yeah.
And Dr. Rakesh Mohan has sent some questions. I will put those questions to you for first. His first question is, what have been the lessons of this whole experience for inflation targeting framework? That's the first question. And the second question, would it be correct to say that almost everyone got it wrong regarding expectations, regarding inflation, regarding GDP growth? If so, does that imply that there is a problem with macro and monetary policy theory? There, I think we can take up these two questions first, then I will come to other questions later.
Okay. So on the first one, lessons for inflation targeting, I think I view this as something of an advertisement for inflation targeting, actually. So inflation expectations stayed pretty well anchored in advanced economies. If you had put in place an inflation target and you had pursued that inflation target in a clear, credible way for 20 years, I think you got a credibility out of that was really helpful. When the inflation hit, you could wait and see, is it going to be transitory or not? Do we need to respond or not? And you didn't get inflation expectations running up and end up with a bigger inflation problem. So to my mind, inflation targeting looks like it was pretty helpful in this experience because it helped to anchor inflation expectations. On everybody getting it wrong, there's some truth to that. Monetary policy is hard. Forecasting is really hard, especially when it's about the future, as the old saying goes. And so, you have to do monetary policy in a world where monetary policy works with lags. And so you're in the forecasting game whether you like it or not, but forecasting is hard. But I think there is wrong and there's wronger. And as I said earlier, I think the policymakers in the US made a fundamental judgment that the inflation was mostly about supply, that they didn't need to react with really, really tight monetary policy. They didn't need to drive the economy into a recession. I think they got that judgment mostly right. They did think that they had raised rates by enough that the economy would be pretty slow over the last year. That turned out to not be right. But nonetheless, that critical judgment, I think, was reasonable and has been very helpful for them.
And his next question is, if getting to 2% inflation implies much higher unemployment, would the Fed consider increasing the inflation target to 3%? Actually, this has been going on for quite some time. So what is your take on this?
So my take is no, they wouldn't do that.
Okay.
Powell has been very clear that the inflation target is 2. They don't have a real interest in raising that. Would it be good policy to raise it? I think it would be very dangerous right after a big inflationary shock to say, given that we've had a bad inflationary shock, we choose not to go back to our target of 2. We're going to stop at 3. Because then presumably market participants will think, well, if there's another inflation shock, maybe they'll go to 4, but not to 3. So you really could undermine your credibility for getting inflation back to the target. So I think both as a matter of policy, that would be a very risky thing to do, and they've been very clear they're not interested in that. I think, among other things, the Fed's mandate from Congress is maximum employment and stable prices. They wrote down inflation of 2 as the inflation target that would help to achieve maximum employment in part, because it's not 0, right? There's measurement error, but even that aside, they're above that. And so, 2's already kind of high, and I think they would be uncomfortable, I think, going higher than that. Congress could do it, but I doubt Congress will want to do it.
Yeah, Dr. Mohan, question is about with regard to its implication for unemployment. But if you go back I think after the global financial crisis, there was an issue when the inflation was very low, whether the US should raise the inflation target just to ensure that it has enough room to maneuver if inflation falls.
No, that's
that discussion, of course, has almost died down. But he is raising this question from a very different angle.
That's right.
Yeah. So he has two other questions which I will just read out. His question is, why have US bank deposit interest rates not moved from near zero despite the huge increases in policy rates? In India's case, there has been very significant monetary policy transmission to bank deposit rates. He's basically talking about monetary transmission, which he says that it's very slow and inadequate or incomplete in the case of US, whereas in India we have almost a complete monetary, not complete but quite large monetary transmission.
Through bank deposit rates.
To bank deposit interest rates.
So in the US, traditionally retail deposit rates, deposit rates of households are very sluggish. They just move very sluggishly with market rates, and they generally are well below market rates. That spread is kind of what banks use to pay some of their bills, after all, to pay for their costs. So I think a fairly sluggish response of bank deposit rates isn't that surprising. I actually don't know if, in response to the most recent rate hikes, the movement in bank deposit rates is even more sluggish than you would have expected based on history. But that may be the case. Banks got squeezed by deposit rates when rates were really, really low. They would have liked to have had deposit rates that were negative to maintain the spread between their return on their assets and their deposit rates. But they didn't dare, and so they didn't do that. So partly I think rates went up, and deposit rates, which banks wanted to be negative, the notional deposit rate moved up, but it still didn't move up very much above zero. Post the kind of mid-sized banking problems of a year ago, I know that banks have become much more willing to pay higher rates on deposits. So it may be that deposit rates are finally beginning to adjust more. But I simply don't know the fact of whether deposit rates are even more sluggish now than they've been in the past. They're always kind of sluggish.
Okay. Now, Dr. Mohan's last question is, with the large interest rate increases, one would have expected house prices to fall. Why has that not happened?
I think it's a very good question. As I said when I talked about inflation, I think the housing piece is hard to understand. Mortgage rates went up a lot, and home sales fell, so you got some of that transmission. But the supply of houses remained small, remained low, and so house prices, I think they kind of moved around. They stabilized some after a big run-up earlier in the post-pandemic period. So it is surprising they haven't come back down some of that big increase. I guess my thought is there are supply issues in the housing sector that are constraining supply, and so imposing some limit, and so prices have stayed high. But exactly what those problems are on the housing supply side, I don't know. One argument people have made, which I'm not sure I buy, is that there are people who bought houses right after the pandemic when mortgage rates were really low. So you got a mortgage at 3%, and now you have a house and you have a mortgage at 3%, and you're thinking maybe you'd like to move, but boy, a mortgage at 3% is a lot better than a mortgage at 7%, which is roughly what you pay now. And so some people may be frozen in place. What I don't understand about that is, yes, you're not selling that house that you bought with the great mortgage. You're also not buying. So I'm not sure that there's any effect on the kind of net supply-demand balance. You'd be supplying more, but you'd also be demanding more. And so I'm not sure that that's a good explanation. I think it has to be something a bit deeper about the construction industry and home building and so on. But I don't have a good answer. It is a puzzle, I think.
Okay. We can take some questions from just Divya.
Okay, I have a question.
Yeah.
Okay.
So you talked about high deficits and high debt to GDP ratio. Given that, and also with the increased recognition of risks posed by climate change, how can the US Fed, and for that matter central banks around the world, how can they incorporate environmental considerations into their monetary policy framework?
Yeah. So I guess I would divide central banks' response to climate issues and climate risks into two pieces. We were talking about this a little bit earlier. On the, the Fed has a monetary policy hat, they have a bank supervision and regulation hat. On the supervision and regulation side, I think it's really important that you ensure that banks are measuring and managing climate risk appropriately. You don't want banks to make a huge amount of residential mortgages in South Florida where a hurricane could come through and impose massive losses on the bank, unless the bank is really taking seriously how do you model those risks, how do you lay those risks off. So that seems very important as a first order thing. On monetary policy, I'm not sure there is a big implication. It's possible that climate risks will pose risks to the things that the Fed is supposed to care about, maximum employment and stable prices. To the extent it sees those risks, it can react to them as it would to any risks. But it's not a particular thing for climate risk. The Fed just doesn't have a role, doesn't have a mandate, for example, for trying to help with financing a green transition. If the Congress wants the Fed to do that, Congress has to tell the Fed to do that. It just doesn't have a mandate to do that. There's nothing, it has no tools to do that. So Congress could say to the Fed, you need to help with the green transition, you need to buy green bonds in some amount or something like that at some low interest rate. Congress could also just do that itself, right? It could have the Treasury do it. But I think Congress has to speak. I don't think the Fed at the moment has a mandate or a role there.
One last question from the floor, then we'll take two questions. No, we are running short of time. Divya, yeah, you can ask them. We'll take question online. Yeah.
So during COVID, we saw federal borrowings increase substantially, right? And it's almost about 18 to 20% higher than it was pre-COVID. So given this, how do you foresee the relation between monetary policy and fiscal outlook evolving? And a second small question is, when you're saying that US would have a soft landing, what GDP growth do you see? Is it going to be the average 2% lower than that? Yeah.
Sorry, what was that last point?
The last part is on the soft landing. So when you say that US might have a soft landing, what GDP growth for the US are we expecting? Is it going to be the long-term average of around 2%, lower than what it is right now, 3 right now? Or is it going to be much lower than that?
Yep. So on your first question about government debt and monetary policy, I mean, I think the Fed is an independent central bank. At some level, it should be indifferent. Congress is setting fiscal policy, it's setting debt and deficits. The Fed's objectives are maximum employment and stable prices, and that's what it should aim for. Chair Powell's done a very good job of saying, when asked during congressional testimony about fiscal policy matters, that's your problem, not the Fed's job. Right? We'll stay in our lane, we're going to do monetary policy. I think that's the right answer. On the soft landing, there may be a period of slower growth than trend, but I would hope that a year from now or so we'd be looking at growth around trend, an unemployment rate around the longer term normal level of unemployment, and inflation around 2. That's kind of what you mean by a soft landing, that you get back to stably to an economy that's operating more or less at potential with inflation at target.
Okay, we have received 2 more questions online. One is, could the post-pandemic inflation, this is by Dr. Anurag Bavaria, Could the post-pandemic inflation be attributed to the lack of sufficient coordination between fiscal and monetary policy? And another question is from Sandeep.
Bring the mic closer, please. Sorry.
Okay. Another question is from Sandeep Hasurka. His question is, what are the long-term implications of quantitative easing and monetary policy followed over the last few years on the status of US dollar as a global reserve currency?
So on the first one, I'm not sure there was a lack of sufficient monetary fiscal cooperation. There isn't in the U.S. a lot of monetary fiscal cooperation, but the monetary policymakers, in effect, take as given what the fiscal policymakers do. And so I think the monetary policymakers could see the fiscal actions, and they took what they thought were the appropriate policy actions subsequent to that. So I guess I wouldn't blame the post-pandemic inflation in the U.S. on monetary fiscal cooperation, because I just don't think that cooperation, the way that works, is fiscal policymakers are the first movers, and the monetary policymakers act second. On the long-term consequences of QE, I guess I don't see strong implications of that for the international role of the dollar. The argument I'd make is that QE was important to provide accommodation so that the U.S. economy would recover strongly and grow well. Having an economy that's persistently weak, with low growth, with low inflation, with low employment, doesn't make it an attractive place to invest, doesn't make it an attractive place to put your reserves. I think a robust U.S. economy is helpful for the world, and is helpful in terms of the international role of the dollar. So QE is part of that. If monetary policy is done badly, that's bad for the international role of the dollar. But done appropriately, QE is part of the monetary policy toolkit at this point, and using monetary policy appropriately seems good on that score.
Thank you very much. And let's give a big round of applause.
Thanks so much. That was fun.
Thank you very much for a most interesting and stimulating talk and generating so much of discussion. And we're very fortunate to have you here, and the more so because it's at an inflection. The timing couldn't have been better. The world, I think, as a whole is looking at the inflection point from the Fed Reserve, which still drives the global economic cycle. And tomorrow's the meeting, and there's intense expectations whether is there going to be a Fed pivot or not. There were a lot of additional insights that we obtained from you and your talk on US monetary policy, and I recommend everybody to read the book on lessons from monetary policy responses across the world. It's a great compilation, and including the lessons from the pandemic. I'm quite sure that there will be further lessons. It's early days yet, and we hope then to welcome you again to update us all on that. And with that, I thank everyone in this room and all the listeners online. It's been a great attendance. Thank you, Professor English, once again.
You're welcome. Thanks so much.
Thank you all.
Thank you very much. It was wonderful. That was fun.